The stock market is too risky. The stock market, it's already gone up so much. What if you invest in the stock market and lose money? How many times have you heard statements like those? I've sure heard them a lot, and in my humble opinion, these types of statements are lies. They are lies out there that scare away potential investors, and they scare away people who might already be investing and thinking about investing more. In today's video, as a dividend investor of 20 years, I want to present a different argument. I want to present a different side of things that dispel these lies, these rumors about personal finance and stock market investing. So get ready. I have an exciting video for all of you today. So I want to start today just with some figures, with some facts. I have an interesting figure that I want to share on the screen with all of you right now, and this pertains to the national debt. If you go to this website called usdebtclock.org, it calculates the U.S. national debt in real time. And what you see right there is the U.S. national debt. It's $25.7 trillion. Just staggering. This is $77,989 per citizen and $207,000 per taxpayer. So in a nutshell, in my humble opinion, the U.S. national debt, it is a bit out of control. It is a bit out of control, and I have noticed this for many years, many decades now, quite frankly. I've been following the U.S. national debt, and it keeps getting bigger and bigger and bigger. And so I want to share on the screen with you right now another screenshot, and this screenshot is of some of the stimulus initiatives of 2020. And so we know right now we're in the middle of a global pandemic. This has been an interesting year, to say the least, a year that many people are looking forward probably to having over and moving on from. And you can see here on the screen how the government, the U.S. government, has responded to the economic devastation that has come to fruition in 2020. They've done two things. The federal government has issued over $2 trillion. They started with $2 trillion, and then they added on another $484 billion of money to stimulate the economy. In parallel, the Federal Reserve cut interest rates. They cut interest rates down to a range of 0 to 0.25%, and they went ahead and injected $6 trillion of economic stimulus. And so between the federal government and between the Federal Reserve, we are looking right now upwards of $8 trillion of added financial stimulus just this year, just in this single year of 2020. And so the reason I'm sharing some of these facts and figures is to share the backdrop as to why, in my opinion, these types of statements that I started with, they're completely wrong. Money, in fact, fiat currency, in fact, is much more risky than owning stocks, owning shares of world-class businesses like Starbucks that operate day in and day out and generate increasing streams of profits over time. And so with that, I actually want to define a term. There's this term called fiat money, fiat currency. I'm going to share this with you on the screen right now. Check it out. This is very interesting. What fiat money is it's inconvertible paper money, and it's made legal tender by government decree. And so what this means with fiat money, you can't exchange that money for any solid material assets. Stocks, by contrast, stocks such as shares in Starbucks, they are backed by all of the operations, the business, the cash flow, the assets, the real estate that Starbucks owns. By contrast, fiat money, aka the US dollar, it's not backed by anything anymore. In fact, in the olden times, it was backed by hard assets, by gold. I'll share on the screen with you. You can see that it was, though, in 1933 that President Franklin D. Roosevelt, he cut the dollar's ties with gold. And then again, in 1971, the gold standard was completely removed when President Richard Nixon announced we are off the gold standard, and he said that foreign governments can no longer exchange dollars for gold. And so what happened right now, the gold standard is gone. The US dollar is not backed by gold. And in my opinion, it's basically just backed by the faith of the government. It's a paper currency. It's a fiat currency. And so a lot of the time, these statements that are made, it's better to hold money than stocks. These statements that are made that cash is king, if you will. In my opinion, yes, it is very important to have an emergency fund of cash. You never know what will happen in life. But holding cash for long periods of time, in my humble opinion, is not a very solid investment strategy. In my opinion, stocks, even though they can be volatile in the short run, and I'll share some examples of that. I'm a shareholder in Starbucks. I'm a shareholder in McDonald's. I'm going to share those examples with you in today's video. They can be quite volatile, but over long periods of time, stocks tend to perform very well, especially high-quality dividend stocks that pay cash flow that I can use to pay my bills and live off of. And so what I would say is a lot of people cling to the dollar these days. They cling to it because there's this concept of fear. There's this concept of financial fear that the stock market is so risky, that you can lose money in the stock market. But I like to flip it around a bit. I'm going to share on the screen right now some statements just about life. In my humble opinion, there's a lot of uncertainty, there's a lot of panic, there's a lot of worry that gets placed on investing in stocks. But quite frankly, when you think about life at a higher level, there's a lot of risk just with life in general. And so it's so interesting to me why the financial media often paints it as being risky for an individual investor to select stocks. When you just look at life, anything can happen. Look what's happening in 2020. It's a very uncertain and volatile and strange time that we live in right now. But in my humble opinion, high quality dividend stocks, they're one of the least risky aspects of life. Out of everything that could happen in life, high quality dividend stocks, they create a sense of freedom, they create a sense of stability, they create a sense of financial well-being, especially over the long term. And so I feel very comfortable acquiring dividend stocks, and I'm buying right now, even though the market has rallied. Just today is Monday, every Monday I do it, I bought more shares of Starbucks. It's how I like to start my week, on a good note, and so I bought more shares, and now I am buying shares of Starbucks significantly higher than I was buying just a few months ago, and I'm going to share that with you in a few minutes. But the stock price has rallied up, and one of the major points of today's video is because my time frame is so long, because I'm looking decades into the future, I don't worry too much about timing the market bottom perfectly. Yes, I am proud of the shares that I bought at the market bottom, near the market bottom. We'll talk about that in a minute, but I am still just as proud of the shares that I am buying now, and I'm happy to keep accumulating. And I think this is something that I am doing right, and that so many people are getting sidelined. They're getting sidetracked by these lies that the market is so darn risky that you ought to completely avoid the market, or you should only buy the market when when stocks are at bargain basement prices. What's so funny is even when stocks are at bargain basement prices, there was a flood of comments on this channel saying that it's over. Stock market, it's gone. It's never going to rebound up again. But look what's happened. All of the high quality stocks, they have rebounded. And so it's so interesting to see that. And for me, I don't buy into the lies. I have a plan. I stick with it. And I see the progress before my eyes with dividend stock investing. And so I just want to paint the picture here of why I invest in dividend stocks, why dividend stocks are so important to me. And then I'm going to go into some examples today, and I'm going to share some examples of McDonald's and Starbucks to show you exactly what I'm doing in real time and why I just don't buy into these lies. I keep on buying. And so I'm going to share some more thoughts on the screen with you right now. The reason I like dividend stocks so much is if the right fundamental analysis is employed, if I go through all of the hard work of selecting the right stocks, they're of extremely high quality. In my opinion, they are of higher quality than the dollar, holding the US dollar, for example, because I am owning stakes. I have fractional ownership in real quality operating businesses that are going to be around for the long term, that are able to adapt with the times, to change with the times. They're able to have pricing power. They're able to make investments and improve upon their businesses. And quite frankly, these businesses are global, and so they have the opportunity to see the benefits, the fruits of their labor of working globally. And so it's a global investment for me. Dividend stocks are diversified. When I buy stocks across industries, I own 46 dividend stocks. I employ diversification that mitigates my risk. But even within one single dividend stock like McDonald's, I have diversification because they're in the real estate business, they're in the restaurant business, they're in the technology business, if you will. They bought a bunch of tech startups. They're in artificial intelligence and predictive modeling. And I have geographical diversification with McDonald's as well. These are truly passive instruments. And so these days, holding the US dollar, interest rates are so low, there's basically no benefit of holding it. There is no money coming through, no cash flow. But with dividend stocks, my dividend stocks that I own, they pay healthy dividends that are sustainable, that are growing. Many of them are growing the dividends throughout this crisis. And so these are truly high quality, truly passive instruments. And look, I don't have to do anything to receive that passive income. They just keep paying the income whether I check on my stocks or not. And so they provide cash flow. I talked about that. They are sustainable. Dividend stocks, the type that I own, they will be around for long periods of time. They are not going anywhere. And the performance has been great. I have back tested my portfolio several different times. And most recently, I'll share a link to that in the description below. When I back tested my portfolio over long periods of time, decades, it is beating the S&P 500. And so I don't strive to really beat the index because I'm investing for cash flow, but the performance is just staggering. And over the same periods of time, just holding cash in US dollars, the value is eroding and eroding and eroding. And so there was actually, I want to share with you something on that. Many people these days don't believe that there is inflation. They don't believe it. But there's this concept that was published by the author Pippa Malmgren, and she wrote a book called Shrinkflation. And the concept of this book that I very much believe in is even if the prices of goods are not necessarily going up, what you get is less and less and less. For example, the same carton of ice cream that you might have had a decade ago, it has just a little bit less in it. And the quality, the taste, it's nothing like it was before. The same box of diapers, for example, instead of having 20 of them a few years ago, now it has 15, but the price is the same. And so it's so interesting when you look at things like that. I certainly believe, and I see it in the services sector for sure with the price of housing, for example, that there is inflation. And so why would it make sense to buy in to these lies that it's too risky and to keep money in an asset that is eroding in value when there's an opportunity, if one is a long-term investor, if one is investing over very long periods of time, to grow wealth staggeringly, to beat the index and to enjoy the benefits of cash flow. And so that's why I don't buy into the lies. Now, a lot of people have been asking me recently, I've been buying even though the stocks have rebounded back up. And so I'm going to share some examples with you on the screen right now. I want to start with McDonald's. And this is a stock, I'll share it on the screen right now, a stock that I like so much. I've owned this one forever, for a very long time. And you can see here, I started accumulating this in 2011. And the way I like to accumulate stocks, and the proven strategy that's worked for me, is I dollar cost average in. I keep buying and buying and buying and buying, and I don't stop buying. And I make it part of my financial plan. I make it part of my work week. Every Monday I'm buying Starbucks now. The reason I do that is it keeps my head in the game, it keeps me focused on the goal, it keeps me involved in the market, and it allows me to do something called dollar cost averaging, which in general mitigates risk, because if I have, say, X dollars to deploy and I put them all in, What if the stock drops the day after and drops in a horrible way? It's better to smooth it out over time and to progressively average money in. And so you can see that's what I did with McDonald's. But it's so interesting because you can see when I first started buying this in 2011, it was at $73.53. But it so quickly climbed from there. That was in March of 2011. By April, it was at 76. By May, I was buying at 81. By June, I was buying at 81 again. In July, 85. August, 87. September, 88. In October, I was buying at $90. November at 92. December at 98. And then December, I closed it out with another tranche at 97. And so you can see here the tranche that I bought in December as compared to my initial tranche in March, I paid 33% more. The stock in less than a year, the first year that I bought McDonald's, in less than a year, the stock climbed 33%. And so many people, these pundits, these skeptics, these people that are so risk averse, they're saying, Ian, you're crazy. Why do you keep buying it? It keeps going up. It's not going to keep going up forever. Can't keep doing it. It's too risky. As you buy higher and higher and higher, you're taking on undue risk. And so these are the types of things that are always said. And when people say these things, it sidetracks people. It sidetracks them from participating in the market altogether. It takes a huge opportunity away from people of financial freedom, financial independence. But I don't listen to the noise. My investment horizon is for the long term. It's for many decades. I am buy and hold forever. And so I had no problem paying prices in December of 2011 that were 33% higher than the prices I was paying for the same thing in March. Now fast forward to today in 2020. Right now, as of May 29th, this was of last Friday, price per share is 186. And so with the price per share of McDonald's at 186, you look retrospectively back at 2011 and all of the quote-unquote risk I was taking on. But heck, whether I was buying at $70 or $90 or anything in between in 2011, it just doesn't matter in hindsight, because when you fast forward through time, it has been proven that, at least in my portfolio, when I buy high quality businesses that are stably growing, that have competitive moats, that are world-class, that have great financials, that pay great dividends, that reward the shareholders, that reward the customers, that reward the employees, everyone wins. And so it doesn't always happen in the short run. You saw it in 2011. It's gone up. It was harder and harder for me to invest. You'll see more about this as StarBucks in a minute as well. But in the long run, this is why I ignore the noise. And this is why right now, quite frankly, I continue to buy stocks. Now, I'm not going as aggressive as I was when stocks were plummeting this year in March. That's when I went really aggressive. But I am still buying right now. It's June now. It's a new month. It's June of 2020. I continue to buy despite the quote-unquote record valuations. Yes, I am careful. Yes, I am cognizant of where I am allocating my dollars. But with my time horizon, I'm not even looking at this money in the next 10 years. It's 10 years or more into the future. That's why I don't listen to the lies. It's not too risky for me. And so with that, I want to share on the screen another example. This is StarBucks, one of my favorite stocks of all time. And so StarBucks, it actually does include my purchase from today. You can see these aren't all of my purchase of Starbucks, by the way. These are the recent ones. I've been going heavy on Starbucks this year. So you all may remember that my wife, Nicole, and I were participating in Frugal February. We saved up some money in Frugal February and we deployed it into one of our favorite stocks, Starbucks. It's so interesting because when we purchased Starbucks, it was right before the horrible pandemic. And so we purchased it at a higher price and it started plummeting. And when it started plummeting, did we buy into the lies? Did we start getting scared? Hey, it's too risky. It's too risky in the stock market for the everyday person. It's too risky for everyday people to buy individual stocks. No, because we had the experience. We'd been through this so many times in the past with McDonald's, for example. And so we bought all the way down and all the way back up. We did not buy into the lies. And so I want to share with you on the screen right now a history of some of our recent Starbucks transactions. Now, this is not all of the transactions, but this is some of the recent ones from this year in 2020. And so you can see at the beginning on March 2nd, we deployed our Frugal February money and we bought at $80.81. Quickly, it started plummeting on March 11th, down to 68, we bought there. The 16th of March, down to 58, we bought there. 18th of March, $51, we bought there. And then we started buying all the way back up. 27th of March, 66. 31st of March, 67. 66, 71, 76, so on and so forth. And now, as of the 1st of June, it's all the way back up to 78. What is so interesting is the tranche that I purchased today at $78.34 is 53% higher than the lowest tranche, the cheapest tranche that we purchased back on March 18th at $51 and change. And so the key here is leaning in to the experience that we had with McDonald's. McDonald's, it kept going up, 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 and up, but we kept buying. And honestly, all of the tranches from that range in 2011 look like pure gold right now in 2020 because it is so much higher. And I personally believe the same will happen with Starbucks. Now, obviously, we are cautious, we're careful. We prefer to deploy more money when it is cheaper. But even at the current prices, we're happy to average in prudently while having an emergency fund, having cash reserves, because we know that the company is of high quality, we have conviction in it, and we believe in the long run of it. We believe in the dividend income, the stability, and certainly the benefit of owning Starbucks shares versus dollars, fiat currency, or shares in a world-class company. In this type of environment where money is being printed, national debt is so high, financial stimulus is so high, boy, I sure feel more comfortable over the long term owning quality global businesses. And Starbucks, like McDonald's, is a restaurant, but I look at it really as a tech company too, as they have one of the largest mobile payment processor apps around. And so again, key lesson is not buying into the fear, having a solid game plan, having a long-term time horizon, and we'll see, time will tell if this Starbucks experience here in 2020 is going to pan out for me, my family, the way that McDonald's did back in 2011. I think it will. Time will tell, but we're still accumulating. And quite frankly, what's so interesting is this year we've bought some McDonald's too, even at these much higher prices. And I think that's one of the biggest mistakes that investors make, is just because a stock's gone up, they get scared, they think it's gone up too much. Depends on your time horizon, but for someone who does the fundamental analysis, buys at reasonable entry points, and I know Starbucks is getting a little bit expensive, but has that multi-decade approach, hey, I have no problem averaging up. I do it all the time. And so people ask, during this global pandemic, economy doing so bad, why are stocks surging right now? My personal take is some of those statistics that I shared earlier in the video around the national debt, the stimulus package, etc. People are taking a flight to quality. Rather than holding fiat currency, they're taking a flight to quality into dividend stocks. And so that's one of the dynamics that I think is happening in the market right now. And so look, regardless of what your approach is, if you're a pure play dividend investor like me, you have another approach. The point of this video is to listen to your heart, do your own research, don't buy into the hype, don't buy into the scarcity mentality, the fear mentality. Look at the long term. If you enjoyed the video today, please subscribe. It means the world to me. Greatest way you can thank me for producing these videos on YouTube. Before I leave today, in terms of a full disclosure, today's video is... or in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Also, in terms of a disclosure, I am long Starbucks, ticker symbol SBUX, and McDonald's, ticker symbol MCD. I own both of those in my personal dividend stock portfolio. I love you all. I'm back in the corner celebrating 60,000 dividend investors strong. Stay healthy, everyone. Stay safe. I love you all. Everyone around the world uniting around dividends. This is a community for everyone. I love you all. We are all one here, going after those dividends. I will see you in the next video.